Folks, you better get ready. Tom Lee and his team at Fundstrat just did their quarterly rebalance and revealed one stock that you absolutely need to dig into immediately. But first, why should you care? Well, Tom Lee has blown prediction after prediction out of the park. Tom Lee predicted a fast rebound after the 2020 pandemic crash. Tom Lee called out Bitcoin. He predicted the energy surge in 2022. He predicted the bull run the last year and a half. And because it is my sworn duty to keep you informed, I've been digging relentlessly like a dog through Tom Lee's press conferences, CNBC appearances, tweets, and Fundstrat's postings and filings. And today I'm going to bring you three things. Number 1, Tom Lee's latest predictions. Number 2, Tom Lee's main positions. And number 3, one new small cap stock that he likes that stands out like a sore thumb. Let's get to work. Timestamps down below. And as always, if you're the one taking the risk, you got to be the one doing the ultimate frisk. Also, quick plug, in order to celebrate our massive win on Palantir calls, we are doing a flash sale on ZipTrader options membership. Coupon code Palantir70 will get you 70% off. You'll get access to our options alerts, our step-by-step lessons, and our private Discord chat. Sale ends midnight tonight, and this is the biggest sale we've ever done on membership, so make sure to take advantage. Now, Tom Lee, Captain Lee, has yelled at the top of his lungs about how important it is to not fight the Fed. Fighting the Fed is essentially standing in front of a tsunami with a shield. Like, okay, not only do you look like a stupid piece of garbage, but you're also going to drown. Yet a lot of people do just that. They short and short and short into Fed pumps. We've seen that many, many times in the past in 2020 and 2021. We've seen that massively in 2023 and 2024, yet a lot of those people continue to drown. And so Tom Lee is warning, do not do that. In this case, he's saying, hey, friend, we are in the market cycle where we get a Fed cut and no landing. This tends to relate historically to aggressively uptrending markets. Now, what does he mean exactly by no landing? Well, he simply means you're not in a massive recession. The economic plane is still flying, so to speak. Now, I'm sure many of us would argue that it's flying like a lopsided plane where the middle class is being dragged out like that one dude from the United flight a few years back. But nonetheless, Tom Lee is arguing that economically, this period we are in today is similar to 7 other economic periods throughout our history, and when you look at market returns during those periods, well, 3 months forward, the average return was 8.4%, 6 months forward, 12.8%, and the win ratio was 100%. So those are pretty good statistics if you believe in history and historical backtesting. Pretty good statistics suggesting that we are set up for more running and rally towing. Now, where exactly does Tom Lee see the S&P 500 trading by year end? Well, at 6,000, which is another 4.5% or so gain. Reasoning? Well, a major reason is firepower. When the Fed started its war on inflation, firepower/cash on the sidelines was at $4.7 trillion. It went down a bit in the beginning because you had an inflation spike and people were rushing to figure out where to put their money, but overall it ended up drawing huge amounts of cash out of equities and into money market funds, yielding high returns. And that level of cash on the sidelines is now at about $6.42 trillion. And before 2020's mass stimulus, it used to be that sideline capital was way down here in the $3 trillion range. Just to get back to pre-2020 levels of sideline cash, you would need to see an outpouring of some $3 to $4 trillion of firepower, much of which would presumably find its way into high-performing stocks, causing prices to go up very fast. In terms of other recent updates, Lee highlighted China. He explained that China was the most hurt party by the Fed's war on inflation, far underperforming Europe, Asia overall, Latin America, and so now that the Fed is reversing and China themselves are doing a big stimulus package, he thinks it's set for a very sharp rebound, and this is actually something we made a whole video on about a week ago, so make sure to check that out if you haven't already. Lee has also expressed a bullish view on Bitcoin, predicting it could surpass $150,000 in the next 12 to 18 months. His reasoning includes the upcoming Bitcoin halving, growing institutional interest, and the belief that Bitcoin has already weathered most of the regulatory hurdles. He sees Bitcoin as an inflation hedge and expects it to benefit from the same easing conditions that will drive stocks higher. In terms of the Middle East conflict, a lot of people have been arguing that the time to sit out of markets is when you get an invasion or an escalation, whether that was October 7th of last year or Russia, Ukraine, so on and so forth. But Tom Lee is arguing that sitting out markets during the beginning or even escalation of these conflicts doesn't make much sense because the dips tend to just get bought up super fast afterwards and tend to be a nice growth opportunity. He argues that you should be buying invasions, not selling them. Now, I want to take you back to the bigger picture here. Fundstrat argues that automation combined with a shortage of labor is going to do what it always does, drive tech stocks to go absolutely parabolic. Now, when we say labor shortage, what do we mean? Isn't the unemployment rate actually trending up right now? Well, yes. But there's 3 parts of the coming labor shortage that Tom Lee wants you to know. Number 1, the labor shortage that is going to come from an aging demographic. As the baby boomer generation leaves the workforce while continuing to create huge demand, well, there's going to be a massive imbalance there. Number 2, there's a labor shortage of properly skilled workers. There's a lot of people right now that are in jobs that unfortunately are going to be automated away. And in terms of people needed to manage those automations, well, there's not many people that have those skills. And number 3, there's going to be a massive labor shortage caused by the decline in cheap labor. As governments and unions push to mandate higher and higher labor costs, it's going to create a shortage or a complete inability to get cheap labor, which then in turn further emboldens companies to invest in automation. All of these 3 things are going to contribute to a massive tech demand increase and a massive tech bull run. Okay, so where does Tom Lee think you should put your money? Well, he's long talked about mega stocks like Nvidia. However, bigger picture, he does think that small caps are the better bet. Why? Well, because small cap EPS, earnings per share, is faster growing as compared to the S&P 500, which is why I believe he's also recently added Palantir to his conviction list, by the way. Tom Lee argues that it's better to buy earlier stage companies that are growing fast and in their fast growth, exponential growth period than to buy more mature companies that are seeing more sustainable but albeit much slower rates of growth. Small caps also have the benefit of largely being undercapitalized because of the massive growth crash in 2022. So that's a nice bouncing board to come off of. Now, I don't want to beat around the bush. We're going to get into Tom Lee's latest stock, but first, you need to have an understanding or at least a refresher on his criteria for picking them. He calls his top stocks granny shots. Granny shots are not just Tom Lee picks that he pulled out of his shoe after a long hike. No, these are real deeply researched stocks from his firm Fundstrat. And overall, they've beat the S&P 500 this year, and in many cases, many individual top plays have far outperformed. So what are the criteria for these so-called granny shots? Well, here they are. Here, I'll go through them very quickly. Resilience through economic cycles, strong balance sheet, high quality management, predictable cash flows, dominant market position, secular growth trends, stable revenue stream, strong free cash flow, attractive valuation, shareholder-friendly policies, you can't have a lot of dilution, low volatility, and lower risk. These are his main criteria for granny shots. So then what about the main stock of today's video? Well, if you dig through the filings and postings, you'll find that LendingTree, ticker symbol TREE, is actually one of his top small cap stocks that really stand out like quite the sore thumb. And interestingly enough, the stock has already been on a nice consistent breathing uptrend. So what exactly is LendingTree? Well, LendingTree is an online marketplace that connects consumers with lenders and financial service providers, helping them compare and choose from a wide range of financial products. Now, I know you've heard of this company before, but the company provides essentially a platform for individuals and businesses to explore various loan options, credit cards, and other financial services without having to individually apply to multiple lenders. So why exactly might he like this stock? Why LendingTree? It's actually very simple. Falling interest rates mean more people are looking for loans, refinancing, and comparing financial products. That's where LendingTree shines, connecting consumers with the best deals, and that's exactly why Tom Lee sees it as a prime pick. The shift in interest rates right now, what the Fed is doing is fundamentally changing the dynamics of borrowing and lending and creating markets that didn't exist a year or two ago. As rates continue to fall, you're going to see much lower borrowing costs for consumers. They're going to be much more likely to take out personal loans or eventually refinance existing debt. Those who had variable interest rate debts that have gone up, well, they might be refinancing to lock in a lower rate for a longer term period. You're going to have business loans surging with cheaper credit available. All of these small businesses are going to be much more inclined to borrow for expansion and or working capital. LendingTree is very uniquely fit to handle and facilitate these overall business loans. And its platform makes it super easy and will attract a lot more users, further driving some growth. Whether you're talking about personal loans, mortgage refinancing as rates go even lower, and credit card and auto loan refinancing, or just completely new debt, LendingTree is very uniquely positioned. So in other words, you could say that, hey, maybe Tom Lee is looking at this stock and is excited about this stock specifically because we are heading into an environment where lending activity is primed to pick up a lot, but we're not quite there yet. This is a unique opportunity to look at the stock, and you're starting to see it pick up because not only are we not exactly at that low rate environment yet, but it's pretty clear that we're gonna be over the coming year or two. And that's why a lot of people are buying in right now, trying to price that in ahead of time. But there's also more to it than that. LendingTree has been expanding its product suite beyond loans to include insurance comparisons, savings account comparisons, credit monitoring, and more. This diversification is a key driver of future growth as it allows the company to generate revenue from a wider range of financial services. Now, going back to the super granny criteria, how does this stock fit that criteria? Or rather, which criteria does it fit? Well, number one, resilience through economic cycles. One of the key elements of Tom Lee's super granny stock is resilience. These are stocks that can weather economic downturns while still delivering solid performance. LendingTree fits this bill pretty well. They have very diversified revenue streams. LendingTree is not solely dependent on one type of loan or financial product. When rates are high, LendingTree can charge more. When rates are low, LendingTree sees more demand, so that's nice. There's a lot of adaptability there, and of course, there's other products as well that they have. Another criteria is massive growth potential and strong financial performance. LendingTree's expanded role in the online financial services sector positions it as a very high growth stock. As a fintech platform, LendingTree has positioned itself as a digital leader in the financial marketplace. Its ability to scale and capture market share in an increasingly digital economy aligns with Tom Lee's preference for companies that are benefiting from secular growth trends. LendingTree's consistent growth in revenue from personal loans, credit cards, and insurance comparisons show that the company can capitalize on consumer needs in various segments. So again, you got diverse revenue growth opportunities. You have profit margins and efficiency. LendingTree has been working on improving operational efficiency, which could lead to expanded profit margins in coming quarters. Tom Lee values companies that have strong earnings potential, and if LendingTree can continue to increase its margins, it would further fit his criteria as a granny stock. Another one of the criteria it hits is the cash flow and financial health criteria. Tom Lee's super granny stocks are often characterized by strong balance sheets and solid cash flow, and this one is no exception. LendingTree's ability to generate cash flow stems through multiple revenue streams, and that means that it can reinvest in the business and explore new opportunities, whether it's through strategic acquisitions or further platform development. With its history of capitalizing on market trends and expanding its product offerings, LendingTree's financial health gives it the flexibility to grow without taking on an excessive debt or relying on volatile short-term trends. LendingTree may also consider doing share buybacks, which would be attractive to Tom Lee's criteria, and they have the money to do it, so there's that. Another criterion that it hits is it is a beneficiary of long-term secular trends. Tom Lee is particularly fond of companies that benefit from secular trends, which are powerful, sustained growth drivers that can last for years or even decades. And LendingTree is well positioned to benefit from several of these secular trends. Increased consumer focus on financial health, increased consumer focus on easy lending, the digital transformation of financial services, and fintech growth overall. It's also positioned for economic recovery. Tom Lee is known for making bold calls regarding economic recoveries if he believes that the U.S. economy is on the verge of a recovery, or certain sectors of the U.S. economy in this case are on the verge of a recovery. Well, stocks that benefit from that, like the borrowing stocks, are going to be on his list. And again, as interest rates fall, well, the borrowing side of the economy is going to skyrocket. Tom Lee also cares about attractive valuation relative to growth potential. Mr. Lee seeks stocks that offer a combination of growth potential and attractive valuations. If LendingTree stock is trading at a valuation that he considers to be below its intrinsic value, especially relative to its growth prospects, it would be appealing under his super granny list. LendingTree's ability to generate consistent cash flow and grow across multiple business segments while at the same time being at long-term lows suggests that this is the case here. So anyways, folks, there you have it. Tom Lee's latest predictions and one stock that stands out amongst his list of new opportunities. Let us know down below what you think about Tom Lee's latest, and also make sure to take advantage of that coupon code Palantir70 on ZipTrader options that expires at midnight tonight. Have a good one, folks. We'll see you next time.